Welcome to the debate. It is February 2026, and on February 5th, a specific statement from Strategy CEO Fong Lei sent a very genuine shiver through the financial markets. She stated that Bitcoin would need to fall to roughly $8,000 before the company faced a critical failure point regarding its debt assets. Now, historically, that was meant to be reassuring, right? A demonstration of how far down the floor actually is. But the market heard something else entirely. They heard that there is, in fact, a floor.
Yeah, and right now, looking at the screens, that floor feels a lot closer than it did a year ago. We are looking at a landscape where Strategy, which was formerly MicroStrategy, is officially underwater on a $54 billion bet. The water is rising, and the question we're really grappling with today is fundamental. Is the corporate treasury model facing a catastrophic, cascading liquidation event because of these copycat failures? Or, is this merely a healthy shakeout of weak hands that ultimately strengthens the ecosystem? I'll be arguing the former, that the systemic contagion is a clear and present danger.
Right, and I represent the other side of that coin. I'm arguing that Strategy has built a true fortress balance sheet, one that is designed specifically to weather this exact storm, and that the $8,000 figure is essentially a theoretical metric, not a practical risk. The panic is misplaced.
Well, I'm arguing that the fortress is built on a fault line. The buffer is entirely gone, the copycats are collapsing around them, and the systemic contagion is just a danger we can no longer ignore.
Let's get right into it then. I want to start by addressing the elephant in the room, which is the price action. Yes, Bitcoin is currently trading in the $60,000 to $68,000 range. Yes, Strategy's average purchase price for its massive stack, which is 717,131 Bitcoin, is $76,027. They are in the red. But this is exactly where the market is making a massive category error. They are treating Strategy like a hedge fund trading on margin.
Well, if it walks like a duck and leverages like a duck.
But the structure of the leverage matters. It is absolutely everything. Strategy holds 3.4% of the total Bitcoin supply. The critical detail that the panic sellers are missing here is that these assets are unencumbered. Strategy didn't take out standard margin loans against their Bitcoin. They issued convertible senior notes.
For the listeners who aren't necessarily bond traders, let's be very precise about what that means in this context.
It means there is no banker who can just call Fong Lei tomorrow and force a sale just because the spot price dipped. A margin loan has a hard liquidation trigger. If the asset drops, you sell or you add cash. Convertible notes are just debt they can turn into stock later. Strategy owes the money, yes, but the Bitcoin itself isn't collateral that gets seized by a bank. This isn't a bug in their system, it is the primary feature. They designed it so they literally cannot be forced to sell the Bitcoin to pay the debt today.
You're making a very compelling argument for why Strategy won't file for Chapter 11 bankruptcy tomorrow morning. And on a purely technical, legal basis, you are right. But I think you're missing the forest for the trees here. You are incredibly focused on the legal inability of creditors to seize assets. I am focused on the financial reality of the balance sheet today. Strategy spent $54.5 billion to acquire that stack. As we sit here, they are sitting on nearly $6 billion in unrealized losses.
Paper losses.
Paper losses become real panic very quickly. We aren't just talking about math. We are talking about sentiment and the company they keep. Look at the recent exits. Peter Thiel and the Founders Fund fully exited their position in Etherzilla, which is the Ethereum treasury proxy, on February 17th. When the smart money, the deepest macro thinkers in the valley, head for the exits, it signals that the easy money phase is definitively over. My argument is that while Strategy might not get liquidated tomorrow, the copycat crisis firms like BitMine Immersion, sitting on billions in losses, creates a massive blast radius. You can be the safest house on the block, but if the rest of the neighborhood burns down, your property value isn't staying up.
That distinction between Strategy and the copycats is exactly where we need to drill down. But I want to stick to your concern about Strategy's solvency first, specifically that $8,000 figure that scared everyone.
It's an alarming number because it put a highly specific price tag on failure.
But let's clarify what that failure actually is. CEO Fong Lei was explicit. That $8,000 figure is a theoretical solvency flaw where the value of their Bitcoin reserve would roughly equal their net debt. It just means assets equal liabilities. It is not a liquidation trigger.
But it strongly implies that at $8,000, the equity is zero. The shareholders are completely wiped out.
Theoretically, yes. But again, for a liquidation to happen, for the Bitcoin to actually hit the open market, you need a mechanism to force the sale. Strategy has accumulated about $8.2 billion in those convertible senior notes. They are unsecured. The counterparties cannot demand the Bitcoin. So while the price is down, the forced seller narrative regarding MicroStrategy is just structurally incorrect. They can sit on those coins at $8,000, $60,000, or $100,000 without selling a single Satoshi.
You keep going back to the lack of a margin call as if that is the only risk on the table. I don't buy that the lack of a margin call equates to safety. The real danger lies in the calendar. The first major hurdle is September 2027. That is barely 18 months away.
The first maturity date.
Exactly. That is when holders of over $1 billion in those convertible notes have a put option. They can demand cash repayment if the stock performs poorly. And let's be totally honest, if Bitcoin is languishing in a bear market, which is what we are seeing right now, Strategy stock will be underperforming. The bondholders aren't going to convert to stock. They are going to want their money back. Strategy can't just print shares to pay that off without diluting existing shareholders into absolute oblivion. They will need cash, $1 billion of it.
That brings up their cash flow, which I think is the most overlooked part of this entire debate. Everyone treats Strategy like a spot crypto ETF. They forget it's a 35-year-old enterprise software company.
A software company with a massive burn rate. Strategy has roughly $888 million a year in interest and dividend obligations on that massive debt pile. Yes, they have $2.25 billion in cash reserves right now. But if you do the math, that buys them about 2.5 years of runway.
Which gets them well past the 2027 hurdle.
Barely. And that assumes everything stays static. It assumes the software business doesn't slow down. If we enter a prolonged crypto winter, and looking at the charts, it certainly feels like the air conditioning just turned on. That runway gets short very fast. If they have to meet a $1 billion redemption in September 2027, suddenly that cash pile isn't a fortress, it's a rapidly depleting savings account. And if the cash runs out, what do they have left to sell? The Bitcoin.
I think you're painting a worst-case scenario that ignores the management's active strategy. First, the legacy software business is a cash cow. It is incredibly stable. It generates cash flow independent of the price of Bitcoin. Strategy is not a pure-play crypto holding company in the way some of the copycats are. They have a reliable floor of operational revenue.
Is it enough to cover $1 billion redemption, though?
It is enough to service the interest while they restructure. Michael Saylor has already addressed this extensively. The long-term plan is to equitize the debt. The goal is to convert these liabilities into equity over time. If the stock price recovers even moderately, or if they issue new equity to pay off the debt, they avoid selling the Bitcoin. The market is treating Strategy like a levered day trader who needs to post collateral today. It is much closer to a real estate holding company waiting out a property cycle. They have the time to wait.
They might have the time, but do the others? This is where I think your focus on Strategy's specific legal structure misses the systemic risk completely. You cannot separate Strategy from the ecosystem it spawned. In 2025 alone, public companies added nearly 500,000 Bitcoin to their balance sheets. But these weren't all structured with the same discipline or the same unencumbered status as Strategy.
Right. You're referring to the copycat crisis.
I am. And crisis really is not too strong a word here. Look at Bitmine Immersion. They saw what Strategy did and said, we can do that too, but let's make it higher beta. They pivoted hard into an Ethereum treasury strategy. They hold over 4 million ETH.
A massive position.
Massive. And disastrously timed. Their average cost is around $3,800 per ETH. With prices significantly below that now, they are sitting on unrealized losses estimated at over $7.9 billion. That is a gaping hole on the balance sheet. And unlike Strategy, Bitmine is a mining and infrastructure company. Their revenues are tied directly to crypto prices. When crypto goes down, their revenue goes down, and their treasury creates a massive deficit. They don't have a boring enterprise software business to keep the lights on. They are pure beta.
I agree that Bitmain is in a precarious position. They took on the risk without the proper hedge. But does the failure of a copycat necessarily doom the leader? If Bitmain goes bust, does that actually hurt Strategy on a fundamental level?
It creates a severe contagion effect. Galaxy Digital's annual report explicitly warned about this. They stated that 5 or more of these digital asset treasury companies are at high risk of failure or forced liquidation. This is the feedback loop I'm worried about.
Walk us through the loop.
Prices drop. The equity value of these copycat companies evaporates because their treasuries are deeply underwater. Their ability to raise money, which they desperately need to operate, vanishes. They become forced sellers, not because they want to, but because they have operational costs or secured loans that are getting called. When they dump 4 million ETH or their Bitcoin holdings into a thin market, prices drop further. We have seen this exact movie before. We saw it with Luna, we saw it with Three Arrows Capital. Forced sellers do not care about fortress balance sheets or theoretical solvency. They sell because they have to. And that selling pressure drives the price down, which brings us perilously closer to the levels that actually do threaten Strategy's debt covenants or shareholder confidence leading into 2027.
I see the mechanism you're describing and the historical parallels, but I interpret the outcome very differently. You call it a feedback loop of failure. I call it a transfer from weak hands to strong hands. The copycat model is what is broken here, not the treasury model itself.
That is a very convenient distinction, but the market tends to punish the whole sector indiscriminately.
But look at who these copycats were. In 2025, we saw a lot of tourists, companies buying assets for marketing purposes or to pump their stock price because crypto adjacency was a buzzword. They are getting washed out. That is painful, yes. But is it a systemic failure? I would argue it is consolidation. When a firm like Bitmain is forced to sell, who buys? It isn't retail traders on 100x leverage. It is the long-term institutional holders. It cleans the ecosystem of toxic leverage.
But is the demand actually there to absorb that supply? That is the other half of this equation. You are assuming there is a solid floor of buyers waiting to catch these falling knives. But for the last 2 years, the corporate treasuries were the buyers. Strategy alone bought 41,000 Bitcoin in January 26. That is a massive amount of buy-side pressure.
They were the whale.
Exactly. If Strategy stops buying because they are underwater and trying to preserve cash, and the copycats stop buying because they are insolvent, that demand shock is very real. You remove the biggest buyer from the market at the exact moment the weak hands are forced to sell. That creates a terrifying air pocket in the price.
You're describing a supply and demand mismatch, which is a valid point in the short term, but you are ignoring the fundamental floor of the asset itself. Let's look at the production cost.
The mining cost.
Yes. This is the hard deck. The cost to mine 1 Bitcoin, just the electricity, not even including hardware amortization, is estimated between $40,000 and $87,000, depending on the miner's efficiency. This is why the $8,000 figure is so absurd to me. If Bitcoin fell to $8,000, it would be trading at a 90% discount to its production cost.
Markets can remain irrational far longer than miners can remain solvent.
But the physics of the network cannot be bypassed. At that price, the global mining network would simply shut down. That has never happened in history. The incentives of the network provide a floor that a stock or a bond simply does not have. Miners will not sell their Bitcoin for $8,000 if it costs them $40,000 to make it. They will hold, or they will turn off the machines, dramatically restricting new supply.
I have to push back hard on that production cost is a floor theory. Commodities trade below production cost all the time when there is a supply glut. It happens in oil, it happens in gold miners. And we're seeing signs of supply coming online from the miners themselves right now. On-chain data shows that Marathon Holdings moved about 1,400 Bitcoin to exchange wallets recently.
Moving to an exchange isn't the same as selling, it's preparation.
It signals the intent to have the option to sell. That is nervousness. When the miners, who know the production costs better than anyone, start moving coins to exchanges, it tells me they are not banking on that production cost floor to save them. They are preparing for liquidity. They have electricity bills to pay in fiat dollars, not Bitcoin. If the price drops, they must sell more Bitcoin to pay the exact same bill. That is a negative feedback loop, not a floor.
It can be for inefficient miners. But contrast that minor behavior with the institutional behavior. You mentioned Peter Thiel selling, and that is a significant signal, I grant you that. But look at BlackRock's iBet ETF. It holds over $54 billion. Look at the sovereign wealth funds. These are not entities that panic sell because of a bad quarter. They are allocators looking at a 10-year horizon.
Are they, though?
Absolutely. If the price drops because Bitcoin blows up, that is a discount for the pension funds. The capital that is sitting on the sidelines waiting for an entry point is far larger than the capital that is currently trapped in these underwater treasury plays. The institutional thesis hasn't changed just because a few copycat companies over-leveraged themselves.
I think you are overestimating the patience of institutional capital. Institutional investors hate volatility, but more than that, they hate uncertainty. If they see a sector-wide collapse of the treasury model, if they see 5 or 6 public companies go bust because they bet the farm on Bitcoin, they aren't going to rush in to buy the dip. They're going to wait until the dust settles, and that dust settling period could drag on for years, pushing us right into that September 2027 danger zone for strategy.
Or they recognize the nuance. They see that the treasury model worked perfectly for the one company that did it right, Strategy, and failed for the ones that did it poorly. Strategy's survival through this period would validate the model, not invalidate it. It proves that if you have unencumbered assets and deep cash reserves, you can weather extreme volatility. The failure of the copycats effectively clears the market of bad actors. It reduces the leverage in the system.
But at what cost? We are talking about billions of dollars of equity value wiped out. The healthy shakeout you describe feels a lot like a systemic crash to the people holding those bags. And my concern is that Strategy, by virtue of its sheer size, owning 3.4% of all Bitcoin, cannot decouple itself from the fate of the smaller players. If the market tanks, Strategy stock tanks. If the stock tanks, the convertible note holders get nervous. If they demand cash in 2027, Strategy has a major problem. The circularity is undeniable.
The circularity exists. I will concede that. But it is not a death spiral. It is a stress test. And Strategy has prepared for this. They have the cash runway to get through the next 2.5 years. They have a CEO who has explicitly planned to equitize the debt over time. They have an asset that is completely unencumbered. The $8,000 number is noise. It is a headline designed to scare people who don't deeply understand the difference between a margin loan and a convertible note.
It might be noise, but noise can cause avalanches.
I'm not convinced by that line of reasoning because it assumes the